So what we're going to have a look at now are the Basel capital adequacy requirements as well as liquidity management. Basel 2 and Basel 3 are capital adequacy requirements. And basically what that means is these are requirements for banks to maintain a certain amount of capital, and that capital acts as a buffer against the different risks that banks face. So the different risks that banks face we'll cover in the following slides, but they basically relate to their credit risk, their market risk, and their operational risk. And what we've seen over time is that the amount of capital, particularly after the GFC, is that the amount of capital that banks need to hold to cover their risks has been increasing. This is what Basel II looked like. So basically we have the three pillars: capital adequacy with the credit, operational and market risk that needs to be considered, supervisory review, and market discipline, which we're going to cover shortly. Now we're going to have a look at Pillar 1, capital adequacy, and the associated credit risk, operational risk, and market risk. Credit risk is the risk that the borrower will not be able to pay back the debt when it falls due. It can be measured in a number of ways. Given this is an introductory finance course, we're not going to look at the different ways it can be measured, but it's important to understand the basic idea that enough capital needs to be held to act as a buffer against the potential for these loans not to be paid back. There is also operational risk, which is risk of loss from inadequate systems or processes, or from external events. So what we're talking about here is things like fraud, workplace safety, systems failure, damage to assets, and so on. So we also need to hold enough capital to act as a buffer to support our exposure to operational risk as well. Again, it can be measured in a number of ways, but because this is an introductory finance course, we're not going to look at the different ways that it can be measured. We have market risk. Market risk is the risk of loss resulting from changes in market values. And these market value changes might be related to foreign exchange, changes in interest rates, changes in equity prices, or commodity prices. They can be general in nature and refer to changes in the overall market value, or specific in nature and changes in the value of individual securities. Again, this can be measured in a couple of ways, which we're not going to look at in this course. But again, the important principle here is that we need to hold capital to support for losses from changes in market value. Pillar 2 looks at supervisory review, where banks have a responsibility to make sure they have enough capital to support all risks beyond those of Pillar 1 and to encourage improved risk management policies and practices in identifying, measuring, and managing risk exposures. For example, risks that aren't captured by Pillar 1, additional risk management practices such as education and training, and bank supervisors are expected to evaluate how well the bank is assessing its capital needs relative to its level of risk, and the bank's supervisors or regulators can require the bank to hold more capital. Here we have a look at Pillar 3, which is market discipline. So here the aim is to develop disclosure requirements. So what this basically means is a bank is required to write a report and disclose on their website, for example, their risk exposure, their risk management, and their capital adequacy. So the market is able to assess information on the capital adequacy of that institution. And prudential supervisors determine these minimum disclosure requirements, and Basel II recommends a range of information disclosures relating to Pillars 1 and 2. With respect to liquidity management, we're referring to the ability to have funds to meet your day-to-day expenses or commitments. And the reason that this is important for banks is because of the mismatch in the maturity structure. For example, banks offer loans to customers and banks accept deposits from customers. So what we might find is that banks need to make sure that they have enough funds to be able to pay back depositors before they might receive payment from one of the loans that they've offered a customer. They have a liquidity management strategy, which is a policy statement approved by the Board of Directors. It's a system for measuring, assessing and reporting liquidity. It has procedures for managing liquidity. And it has clearly defined responsibilities and controls, as well as plans for dealing with potential crises. We learned that banks are the dominant financial institution and have moved from the practice of asset management to liability management. We learned that the sources of funds for banks includes deposits, as well as non-deposit sources such as bill acceptances, as well as borrowings. Banks also provide off-balance sheet business and other services that they charge a fee for, and their use of funds include lending to governments, businesses and individuals. We learned that off-balance sheet transactions are a major part of a bank's business, and we also learned that prudential supervision requirements include capital adequacy, which is keeping enough capital as a buffer for when things go wrong, such as a customer can't pay back their loan, as well as liquidity management and other controls.